Okay, learning objective 5 is nothing different about learning objective 5 is applying all we know, but to a non-manufacturing company. So the book introduces you now to what this process would look like in essence for a merchandiser. So a merchandiser would also have a sales budget to project what it's there. But of course, a merchandiser is buying the goods from a manufacturer, so they wouldn't have a production budget. Instead, they would have a purchases budget to know exactly what their inventory is going to be done. And so basically speaking, merchandisers are different in that they do not produce, right? They simply buy. So none of the production and manufacturing budgets are going to play a role in how a merchandiser looks at this stuff. Okay, so to determine how a merchandiser sees its purchases budget, it looks at their budgeted cost of goods sold. They will know how much they wanted to spend on inventory, what they're going to sell. They're going to add to it any desired ending inventory, and they'll subtract out any beginning inventory. And the difference will be what they are going to be purchasing, their required purchases of inventory for that period of time. Again, usually these are projected on a yearly basis. So we have a company here, Lima. Is it Lima or Lima? I guess if your last name is Bean, it would be Lima Bean, right? But anyway, they have a budgeted sales of $300,000 in July and $320,000 in August. Cost of goods sold is expected to be 70% of sales. And their desired ending inventory, they would like it to be 30% of the following month's cost of goods sold. So what are the required purchases for July? Okay, well, first they will tell you that their budgeted cost of goods sold, which is the starting point in that formula we just looked at in the last slide, is going to be 70% of their sales. So 210,000 is 70% of the $300,000 in July sales, okay, that they talked about here. Then we will add the desired ending inventory. And that ending inventory that's desired is 30% of the following month's cost of goods sold. So the following month is August. The August cost of goods sold is 320,000 times 70%. And then 30% of that is going to be the ending, which is where they get the 67,200. So that gives them a total of 277,200. And then they will subtract out their beginning inventory, which they also will show as 30% of the previous, right? So 30% of the previous, that's this 300,000 times 70% is the cost of goods sold. 30% of that is 63,000. So the required merchandise purchases that they're going to make for the month of July is $214,200. So this is simply playing out what this illustration shows you. So this is what the illustration is, if in terms of the formula, and this basically is what it would look like in terms of their budget for the month. Okay. For a service business, for a service company here, um, they're not making anything, right? But they're doing a whole bunch of work, right? So a lot of the budgeting is going to be making sure that all their professional staff with the services are going to be coordinated and cost effective in that regard. So there are some problems if they're overstaffed, right? Because then they'll have high labor costs, and labor is going to be there for a service company. Labor is their biggest cost. So that's going to mean lower profits, and maybe if the work is too much, overtime turnover is going to be required. Staff will be losing interest in leaving. Of course, if you're understaffed, you won't be able to get everything done, and so you probably lose a lot of revenue. And then, of course, then you're really going to be losing staff because they're going to be working way too much, and they're going to be understaffed. Which you kind of know. You've been in probably places that are understaffed. You see people are working a lot and they're frustrated. They're doing the best they can under the circumstances. For a not-for-profit organization, it's just as important um, that they also do their budgets appropriately, as if they were a profit-oriented company. Okay, it differs a little bit um, because normally speaking, the budget that they use is going to be based on their basic cash flow, right? Expenditures versus the receipts coming in, not on revenue and expense basis. So instead of revenue, they use receipts. Instead of expenses, they use expenditures. These are the terms that are used in nonprofit. Okay. The weird thing is in a for-profit, you start with sales. But in a nonprofit, you start with expenses. You start with expenditures, and so you will go ahead and plan those expenditures accordingly, and to make sure you're going to be able to carry out your mission. Nonprofits are mission based, so they have missions to carry out. So that's important for them to plan accordingly. So management's task then, once they know how much they need for expenditures, is to go ahead and find those receipts, find the money to get that accomplished, which is why you'll often see a lot of fundraising going on, right? There's always nonprofits, whether it's like a Shriners Hospital or a Wounded Warrior, or pets that have been abandoned or abused or other types of things. They're all trying to find receipts. They're all trying to find money to come in to help them meet the expenditures that are there. Budgets must be followed, particularly if there's state and other contracts that are part of that. All overspending is often illegal, with the exception of if the board of trustees of a nonprofit allows some of its fund balance or endowments to be used to budget those types of things. So that's it's a little bit different for a nonprofit, for sure. Okay. Budget shortfalls are pretty common in these areas. This is a museum of contemporary art story, which was in Los Angeles. Well, is in Los Angeles. They learn the very hard way how important budgets are. So over a 10-year period of time, this museum had an endowment. So an endowment is sort of extra money that a nonprofit, a lot of colleges have endowments, a lot of other, nonprofits that are not colleges have endowments like museums and so forth. And this is money that have been given to the organization over a period of time, various benefactors, philanthropists, etc., that might, the arts might be important to them, so they might donate monies and stuff on a regular basis. And a lot of the wealthy have their own philanthropies that they pay attention to and fund accordingly. So this particular Museum of Contemporary Art in Los Angeles had a $50 million endowment. So those are funds that the organization was able to raise over time. They do invest those funds, and so it grows. And so 50 million is a lot. Well, over this 10-year period of time, the endowment shrunk from 50 million down to 6 million. Okay. Why? Because they had a newly hired director of the museum who wanted to build the museum's reputation through spending a lot of money. And that meant that the director constantly run budget deficits, which have to be funded. So, in the case of a nonprofit, like a museum, if they spend more money than they take in from like people visiting the museum, they usually have this pool of money, this endowment money that they pull from to cover the gaps. Of course, there's a limited amount of that money. So clearly, when you went from 50 million down to 6 million, you spent 90% of the, almost 90% of the money is gone, which is a lot. That's an incredible amount. Okay. So that's pretty big, because why? Well, because the entire survival of the museum is at stake if it's spending a lot more money than it's taking in. Okay. This has been true across the boards with a lot of nonprofits, whether it's colleges or uh, churches or other types of groups. It's hard to, if you're a nonprofit organization, it's you can't survive if you don't have that type of money coming in. And if you don't, you have to cut a lot. You have to cut quite a bit. Many nonprofits, for particularly some social services, basically went away. They closed their doors at the time of COVID because they couldn't do their mission. They couldn't service their clients because they couldn't get anything done face to face. So basically, they closed. It's horrible. It's really, really horrible. Um, so here's another side of the story where you have Princeton University, which has a very large endowment. Not as hard. The biggest is Harvard. Harvard has the largest endowment. Um, and so here you had a situation where Princeton University experienced a large drop in their endowment because much of their endowment is invested. Um, and sadly, that endowment was supporting much of the college's budget. Almost half of the college's budget was funded through the endowment. In which case, what happens when that dries up, when that really shrinks? Well, then you're going to have to ask students for more money, or you're going to have to do a lot more fundraising, or a little bit of both, or you're going to have to start cutting expenses, because at the end of the year, you're going to have to show that you're balanced. So it's tricky. It's tricky, and it's very, very important that everyone does it well. So do it. Exercise number 5 ends with a focus on merchandising. And so here we go. We've got Becker. Becker Company estimates their 2017 sales will be $15,000 in the first quarter, $20,000 in the second quarter, and $25,000 in the third quarter. Cost of goods sold is 80% of sales. Management likes to have an ending finished goods inventory equal to 15% of the next quarter's cost of goods sold. Prepare the merchandise purchases budget by the quarter. Okay. So again, there's 2 quarters here. to figure out. So what we have here is their budgeted cost of goods sold is 80% of their sales. And so for the first quarter, 15,000 times 80%, you have your 12,000 there, right? And then what you have is you're adding your desired ending inventory. And they want their desired ending inventory to be 15% of next quarter's cost of goods sold. Well, the next quarter has sales of 20,000. 80% of that is cost of goods sold. That's where you're starting. And then you take 15% of that number and you get 2,400. So they have a total of 14,400, and then they're going to subtract out their beginning merchandise inventory, which is 15% of this quarter's cost of goods sold. Well, this quarter's cost of goods sold is given to you right here. And so 15% of that is 1,800. So the required purchases for the first quarter would be $12,600. Okay. The total of the budgeted costs and the desired ending inventory minus the beginning inventory. For the second quarter, again, budgeted costs, 80% of sales, 20,000 is the sales, 80% is at a 16. Your desired ending inventory is 15% of the next quarter. That's why they gave you quarter three's number here, 25% in sales times 80% of cost of goods sold. That difference, you multiply by 15% and you will get 3,000. So the total is 19,000. We're going to be subtracting out 15% of this quarter's cost of goods sold. 15% of this is 2,400. And so we'll be spending $16,600 on merchandise purchases in the second quarter. And for the first half of the year, we'll be spending $29,200. So a little bit of a different point of view from a service business perspective. And there's a lot of different service businesses. And so your book went through a few. So chapter 10 talks about budgetary control and something called responsibility accounting, which is very important to understand. Right now, we're going to be focusing on the first learning objective, so I can introduce you to static budgets and static budget reports. And so that's going to be our first stop. Okay. So again, using budgets to help control our operations is what's known as budgetary control. We use a whole bunch of budget reports to compare what we had planned to happen to what actually happened. Okay. And that provides us with a lot of feedback on how things are going, in essence. Budget reports are prepared as frequently as needed. Overwhelmingly, you are going to be looking at these at least on a monthly basis. And again, as frequently as needed. If you need to have it more frequently than that, that's fine. The goal of these reports, again, what's the difference between the planned results and the actual results? That's very important. All right, so here you have illustration 10.1 shows you the lots of activities here. You are developing the budget, then you're analyzing the differences between what actually happened and what you thought would happen. Then you're taking corrective action if needed, which means your future plans might be modified a little bit, which means you need to develop a new budget for that or adjust your budget based on that. And off to the races. This can be quite a fun track to ride around in. Okay. So Budgetary control basically looks at a whole bunch of things within the company. The name of the report, how frequent the report's being issued, what's the purpose of such reports, and who's it intended for, who's the recipient that's involved. And so here you'll have, in the first case, you'll have a sales budget. Sales budgets are really important, right? Because it's where your revenue is. And if you're off on your revenue, um, it's at the expense of your profit, how you planned it. So you always want to make sure you're on top of that. Most of the time, those sales budgets are reviewed weekly. And they're reviewed certainly by top management that needs to know about the revenue picture and your sales management. Okay. For other reports like labor costs and your labor budget, that's also going to be quite frequent, usually weekly. It looks at direct and indirect labor costs in what you're producing. Very, very important. So mostly in production, the VP of production, department managers within production are going to make sure that those costs are in line or better than expected. You might have a lot of other different reports that are listed here for manufacturers that deal with different materials. Some materials are scrapped, and so how efficiently are you using things? That's going to be tracked very much daily. I can think about. I would, if I was a bakery, I would definitely want to know if I was what's part of scrap. I mean, it's super important to keep track of various things. Department overhead costs, selling expenses, your income statements are certainly going to be looked at monthly at the very least. And of course, your income statement is looked at monthly, quarterly, and then at the end of the year. So it's very important to know what those are. So now we get to introduce you to something that's really quite fun, although it might look static to you. Might be a hair-raising experience if you have too much static. But a static budget basically is a projection of your budget data, but simply at one level of activity. And you're going to see what I mean by that in a moment. Okay. Static budgets ignore that different levels of activity can occur because it focuses on simply one level of activity. And so it's very hard to use this unless there's some flexibility to it, as you'll see. So here is the budget sales and actual sales data for our Rightride product in the first and second quarter of 2017. We had budgeted 180,000 in sales in the first quarter. We actually had 179,000 in sales. We were off by 1,000. In the second quarter, we budgeted 210,000 in sales. We actually had 199,500 in sales. We were off by 10,500. So in total, our sales are behind by 11,500. That's the difference. Right. Once you put that into a report, this is what it's going to look like. Okay. We are going to show that the Rightride product line for the first quarter, because this is ending March, and we're assuming a calendar year here. We budgeted 180,000 in sales. We had 179,000. The difference is either going to be reported favorably, which is better than expected, or unfavorably, which is worse than expected. So here, this is $1,000 worse than expected. Remember, we expected 180, we had 179. So a $1,000 unfavorable difference is going to be reported here. And that's important to know. I know it looks like an F and a U, and you can play with that, but it's unfavorable. It's unfavorable. Okay. You don't tell your boss, it's either an F or a U. In terms of, I guess you could, but you're not going to work there anymore. In terms of a longer statement, when you're looking at here, second quarter results for the Rightride, we had budgeted 210. We actually sold 199.5. Well, $10,500 is an unfavorable difference because it's below our budget for sales. Okay. When you're below budget for sales, it's unfavorable. When you're above sales budget, it's favorable. So for the year to date, after the first 6 months, you are below your sales projection by $11,500, which is unfavorable. Right? You're going to see the opposite with costs in a moment. So let's take a look at how we use a static budget and what the limitations are. Okay. So static budgets are often used to evaluate how a manager is doing in controlling costs. This has some issues with it, but this is common. Managers, if you're going to be a manager, particularly if in a production or other facility, you're going to get used to this static budget report, and part of how your job is being evaluated is whether your favorable, unfavorable ratings are appropriate. Okay, so so that's static budgets. However, are really just appropriate for fixed costs, as you'll see. Variable costs and static budgets don't really go well together, as you'll notice. Okay. So let's take a look and wrap up our part one here. Lawler Company expects to produce 5,000 units of our product CV93 during the current month. Budgeted variable manufacturing costs per unit are $6 in direct materials, $15 in direct labor, $24 in overhead. The monthly budgeted fixed overhead is $10,000 for depreciation, $5,000 for supervision. Okay. In the current month, Lawler actually produced 5,500 units. So they were budgeted, they were expected to produce 5,000, they produced 55. Right. They incurred the following costs for direct materials, $33,900, direct labor, $74,200, variable overhead, $120,500, depreciation was $10,000, supervision was $5,000. So let's take a look at the static budget report. Okay. Again, the budget's going to be based on these 5,000 units. So in terms of our variable costs, we budgeted for 5,000, and at $6 a unit, we were expecting to spend 30,000 on direct materials. We spent $33,900 on materials. That's $3,900 more than we budgeted for, which is why it's unfavorable. Direct labor, we had actually budgeted 5,000 units at $15 an hour. So there were $15 per unit, sorry, 75,000 in total. Our labor costs were actually 74,200. That was below what we budgeted for, which means it's a favorable outcome. Okay, so for costs, if you're below cost, it's favorable. If you're above cost, unfavorable. The overhead was budgeted at 120. It actually cost 120,500, 500 more than expected, and so it's unfavorable. And so your total variable costs were $3,600 higher than you expected, so it's an unfavorable difference. Your fixed costs were stable, so no problem there. In total, that's your variable plus your fixed, you had budgeted total of 240,000. You spent 243,600, $3,600 more than you thought, which is unfavorable in this case. Okay, so that sort of introduces us to this idea of a static budget. And what you're going to see as we keep getting deeper in the chapter is that, that difference matters. We budgeted at 5,000 units, but if we actually made 5,500 units, does it make sense to compare them? Right. In a static budget, that's what we're set at. Which is why you're going to learn about something called a flexible budget, which allows us to have multiple static budgets. I hope there's not a lot of static going on between you guys, but you're going to be learning that real soon. And boy, is it going to get real fun at that point. Questions?